it's been an absolutely enormous volatility ride in the last 12 months in terms of yield on the US Treasury, on the 10-year US Treasury. There is a good amount of volatility as well on the 30-year US Treasury. However, the 10-year has the most volatility that I have seen. And there's a lot of different factors for this. You have the amount of money that the US federal government needed to raise just in the last 6 or 7 months at Treasury auctions. So the budget deficits are exploding out. You have the Fed doing, of course, a 180 in the last 12 months on the rate hike. The last rate hike was almost exactly a year ago in December of 2018. And then quantitative tightening ended, around August 2019. And then the Fed did a reverse, a 180. Started to cut rates, 3 rate cuts over the summer, and then started to expand its balance sheet before they officially announced the quote-unquote not QE $60 billion per month. And I'm sure that'll end up higher because just in the last 12 weeks, there's a lot of research coming out from Daniel Amerman and also Chris Martenson that there's MMT light already, and a lot of those weekly U.S. federal government budget deficits are being monetized now, around 90%, according to Daniel Amerman in the last 12 weeks. And then you have on top of that hedge fund leverage. So on your chart here, it was very tough for me to fit everything, this entire chart, magnifying it, zooming in. So that's the best I could do, getting everything in there so you can at least see most of what I did there. So you had from December of 2018 to the beginning of September 2019, so about 10 months, give or take, you had the yields on the 10-year US Treasury, you had a over 50% drop in yields. So enormous volatility there. I think a lot of that was Stanley Druckenmiller because he announced publicly, I want to say it was February or March, he started doing speeches at hedge funds, at hedge fund conferences, and also some of these, New York City hobnob charity events where a lot of the finance types go to, and he started talking about some of his investments, and then he did the Real Vision TV interview and the Bloomberg interview and disclosed that he was betting on zero interest rate policy, and a lot of hedge funds were late to that trade and piled in with massive amounts of leverage, probably more than 10 to 1 leverage. And that did not help the repo market because the hedge funds were going in there. And then the hedge funds, some of them were probably large ones, were caught on the wrong side of that trade when the Fed switched their policies because the Fed is scatterbrained. And I think that's what caused the Repo Madness. If you look on the chart there, and I've talked about this in the last couple of weeks, in less than 10 days, we had an absolutely enormous spike in the yields on the 10-year US Treasuries. 26% approximate spike in yields in less than 10 days. And since the beginning of September of 2019 to present, the yields on the 10-year US Treasury are over 33% rise. So that's a lot of volatility in the last 12 months. So in a 10-month span, starting 12 months ago, you had an enormous drop in yields in treasuries of over 50% in about 10 months. And then just in the last less than 4 months, you've now risen on yields over 30%, actually over 33% in yields. So I think the reason, besides the Fed reversing course, I think one of the other reasons is the amount of leverage that a lot of these traders use to put these trades on. There is an absolutely enormous amount of leverage. And some of these hedge funds have put so much leverage on that they're in trouble. That's my opinion. That you probably have some long-term capital management situations out there where some hedge funds were caught on the wrong side of the trade. And what's funny is in spite of all this craziness going on in the 10-year Treasury, the other thing I wanted to talk about with the 10-year Treasury is one of the most famous value investors out there, Howard Marks of Oaktree Capital. He tends to do most of his value investments in bonds. He doesn't really buy a bunch of equities. Occasionally he gets some convertible debentures or he gets some convertible bonds that go into equity. He tends to do most of his value investments, though, contrarian in the bond market. And he, in his opinion, if you read some of his books and listen to his interviews, he also writes an extensive newsletter that a lot of famous value investors read. And he says that everything is priced off the 10-year Treasury. So he thinks, in his opinion, that the 10-year US Treasury is the most important one. But in spite of all this craziness and volatility with yields on the 10-year US Treasury, and also there's been volatility with the 30-year US Treasury, I wouldn't say there's quite as much volatility with the 30-year US Treasury. The range here from, let's see, the range here from the end of December was just above 3%, 3.02, 3.05 in a day. And now it got as low as, let's see here, 1.9. So there's been volatility in the 30-year Treasury too, but the amount of percentage, I think, is more on the 10-year US Treasury. The volatility in the 10-year has been more than the 30-year. But the question then, and I have this on the chart there, is when does the Fed come in and start to cap yields? So does the Fed allow this volatility to occur? Do they allow... Oh, knocked over my teacup. Does the Fed allow... That I already drank, thankfully it's not spilling. Does the Fed allow this volatility to continue? Does the Fed allow the yields on the 10-year to continue to go up? Or when does the Fed start doing full Japanification, which is what has been happening now in Japan, and start capping all the yields? Because the Fed has been telling us now with the interviews that Fed governors have been doing for the last month or so, give or take, that they're going to start capping yields at some point. This is the end game that all the major central banks are planning on doing, is capping yields. Now, in spite of all this craziness with the volatility in the 10-year Treasury, you also, it's counterintuitive, you have not had a lot of crazy moves in the dollar index. So the dollar index has not done a bunch of wild amounts of volatility. It's been fairly range bound. Let me pull up the chart really quick. The dollar index actually now was up today at 97.71. So it was only below 97 for a very brief amount of time, and that was at a 5-month low when it got below 97 to high 96 temporarily. So the dollar index is still fairly range bound, and it's holding up pretty strong. And this fits in with my argument, my thesis, that the demand globally for dollars is still strong. Yeah, I mean, the dollar has been, this year, the last 12 months, the dollar index on December 24th was 96.39. And the dollar index today is at 97.98. And I mean, it got, at one point in June, the dollar index got to 96.13. It did briefly, at the end of January 2019, get briefly below 96 at 95.98, but it has not held there. So it's been fairly range bound. Not massive volatility in the dollar index in spite of the Treasury yields. But today has been a weird day in the stock market because you had yields going up on the 10-year. You had the stock market, I think, was rising. You had gold prices up. You had the dollar rallying. So a lot of those old correlations that a lot of people used to believe in, as even financial professionals, a lot of those correlations are not holding up. And this is because of in my opinion, the distortions that the central banks are causing. All the interventions, all the distortions are all adding up. And those old correlations are breaking down. The trade-weighted dollar index, one more thing here, trade-weighted dollar index is still relatively high. So it hasn't crashed or anything, but it looks like it's now in a correction or somewhat of a downtrend. It's below 130. It's at 129.8642. So it was at 130 at the beginning of the month, December 4th. It was above 130. And now on the chart there, the broad-weighted, trade-weighted dollar index on the St. Louis Fed website that they track, they think it's very important. It's measured against emerging market currencies more than the dollar index, which is against the G6. Dollar index is mostly dollar-euro. So the trade-weighted dollar index is having a little bit of a correction. We'll see if the correction continues. But the dollar hasn't moved a bunch on the trade-weighted dollar index. Let me look up for the last year. Let's see here. Okay, so at the beginning, a year ago, okay, here we go. A year ago, December 26th, which was, they only update it weekly. December 26th of 2018, the trade-weighted dollar index was at 128.53. It got as low as 126. It got as high as 131.57. So it's been fairly range-bound too. And I would say that the trend has still been mostly going up, although it looks like it could be in a correction now. But overall, over the last 12 months, the trade-weighted dollar index has been in an uptrend with some corrections, but fairly not wide trading range. It's only been a 5, give or take, move, a 5 points on the trade-weighted dollar index. So it's similarly not a lot of volatility with the regular dollar index and the trade-weighted dollar index, in spite of all the craziness with the yields on the 10-year, the volatility on that, the yields on the 30-year, the Federal Reserve with the budget, the Federal Reserve reversing 180, and the budget deficits from the Treasury. The dollar has not changed a lot. Oh, thank you, Max. I appreciate it. Thank you, Kim. I appreciate it too. I worked very hard to do this. That took me to get that chart done right there on your screen. That took about 30 or 45 minutes to get all that stuff done, in addition to doing the audio here. So hopefully some people are appreciative. I mean, I put out like a interview yesterday. It took me over 3 hours worth of work, and there was quite a few really nasty complaints on it. I had to edit. It took an hour of editing just to get for the first 40 minutes. That's how bad the audio quality was. I debated not even releasing it at all. With the editing, I think the interview turned out all right, the audio quality. Obviously, some of it I can't control. As I get more Patreon account contributors, hopefully over 300 in 12 months or less, there can be more investments and upgrades. Maybe I can get like some type of sound engineer for part-time, and they could help me improve my equipment and improve the connection. It could be tested out, things like that. So as my business, as more money comes in, I could reinvest into other things. But most of the people who complain like that anyway are the ones who tell me that they'll never give me a cent, even like $5 a month or something to help me improve my content. It's been that way for a long time. But thank you very much to my over 200 Patreon account contributors, my dozen or so monthly PayPal contributors, and people throw me a tip once in a while. Much appreciated. Working on some other big name guests and getting that Dan David interview rescheduled. It's a pain in the butt sometimes getting these. It's a holiday season, so it's going to be even tougher than normal. With the holiday season, getting these interviews done is really difficult. Oh. Oh, Merry Christmas to everyone. Happy Hanukkah to our Jewish listeners. Oh, thank you for the super chat. Is volatility in bonds like volatility in options? Is it tradable? I think it's the MOVE index. MOVE on the Bloomberg terminal. Oh, I got another super chat, thanks. The secure ACT, I'm not familiar with that offhand. Aggregator, I agree with what you just said. Equities are now for income via dividends, and those companies have over-leveraged balance sheets, and the market's not penalizing them for bad balance sheets and paying out dividends they probably shouldn't. But people are now in stocks for income, desperate. A lot of retirees and pension funds. And bonds are for volatility and capital gains. What a messed up world we live in. Yep, every 100 years, over 100 years of conventional finance has been turned on its head and upside down by what the distortions all these 5 or 6 central banks have done. Even spoofers get days off. It's the holidays. These programs can trade on their own. These programs do learn. They can be updated. These high-frequency trading algorithms. Sometimes there's very little human beings watching these things. The dollar has been stable for 20 years. No, the dollar has not been stable for 20 years. The dollar actually long-term has been very volatile. If you look at the dollar index, this is why these emerging market governments and emerging market companies all gambled with dollar-denominated debt, because in 2011, with all the crazy stuff that Ben Bernanke was doing, the dollar index, I think, got to an all-time low. The Secure Act has changes to the retirement programs. I haven't looked at it yet, so I can't comment. But I did sell annuities very briefly when 10 years ago, give or take, during the 2007 and 2008 financial crisis, when I worked as a regular investment advisor representative or registered investment advisor, and took all the Series 7 and Series 66. And let's just say annuities are not really good products. They're good for the people selling them. If you're a salesperson in the regular financial industry, you get a big fact. If you can find someone without a financial education who inherited $500,000 or more, and you're a salesman, and you can get them to buy an annuity for a couple $100,000 or $500,000, you're walking away with a very large commission check in a week. So in general, I'm not in favor of annuities. But it doesn't surprise me that they're going to try to trick people or force people to buy those annuities. Sounds very similar to how the health insurance companies make all this money when, like what Dave Cullum was discussing yesterday about Obamacare, how you would have thought that the health insurance companies wouldn't have been able to make more money, and yet they have. They figured out a way to game the system and make more money off of the inefficiencies and waste, fraud, and the corruption. Midstream companies for oil? Midstream, you mean pipeline? The MLP companies are having tax problems. I'm staying away from MLP companies. The annuity you pay up front, right, to get a guaranteed income at a set date later. So you're paying, for example, you're paying what, 200, I'm not sure of all the different types of annuities, but I believe the basic annuity, you're paying what, for example, this is hypothetical, you're paying what, $200,000 up front. So you can get an income stream for 10, 20 years later in life. But meanwhile, the way that works, it might be for the rest of your life. But but it does not start for a predetermined amount of time. But meanwhile, the firm that's collecting all that cash that you're paying up front gets to invest it. So they get access to the cash now, and they get to invest it before inflation ruins the purchasing power of that currency, of that savings in the future. So annuities are a cash cow for insurance brokers and mainstream investment firms. I mean, we were pushed to sell annuities because they were the biggest commission product that we could get. And a lot of the mutual funds were also high commission, but I mean, most people now don't want mutual funds. Most people now, with their retirement accounts that are not 401ks, that they have some control over, that they go to a regular firm, they want either ETFs in an industry or index funds. Yeah, so I don't like any of the pipeline companies. I know Kinder Morgan's been having some problems. I think they just got out of Canada, if I remember correctly. Kinder Morgan in the last month or two just sold out of Canada because they were having too many problems there. I think the environmentalists were going after them with protests and trying to shut down like pipelines. What about index funds? I mean, the average retail investor should really not be trading that many bonds. Normally, to buy bonds, you need at least $1,000 per bond purchase. There are bond fund ETFs now. There was a very interesting interview over the weekend, I think Thursday or Friday, that Eric Townsend at Macro Voices released with Jim Bianco. And he didn't go into anything really new about the repo market, but there was some really interesting things in that interview that Eric Townsend did with Jim Bianco about trading bonds now and problems with the bond market, and also how these large junk bond ETFs, which are, let me get up my watch list here. The junk bond ETFs are JNK and HYG. And he said that both those two junk bond ETFs, JNK and HYG, they make up an enormous amount of the junk bond market now. And he talks in more details about this, about how they're doing like negotiated side deals with large retail firms for junk bonds because people are that desperate for yield. And now some of these junk bond ETFs are being rated as safe. You should listen to the interview if you want to know more about it. It was some very interesting stuff. Another red flag there. So I guess people are so desperate, and the mainstream financial industry is now spinning these junk bond ETFs, the two large ones, which have an enormous amount of the junk bond market now. It might even be 50% of the total junk bond market now is controlled by these two large junk bond ETFs. It's a massive amount of control these two junk bond ETFs have. And they negotiate and do side deals with like these stock brokerage firms. And they move in, the stock brokerage firms are peddling these large junk bond ETFs as relatively safe, as low risk income streams, as low risk income investments. What about index funds? Do they push those? Vanguard pushes index funds. When I was working there, they did not push index funds because although index funds raises total assets under management, the firm I was working at did not like index funds because of the fees. Now, some of these brokerages used to have index funds and they would charge you an extra 1 or 2% on them, but they're very, very competitive with who can charge you lower fees on index funds. So it really, the way the brokerage business works now, from what I'm understanding it, and I think Charles Schwab just bought TD Ameritrade, right? Or at least there's a bid out on them. So I was reading more about this, is that a lot of these large stock brokerages like Charles Schwab, Fidelity, TD Ameritrade, I believe it was Charles Schwab that just put in a big bid for TD Ameritrade. So what these firms really like to do now, they don't make nearly as much money off of stock trades, because a lot of them now are offering either very deeply discounted trades or no commission trades. And they don't make as much money off annuities anymore because people don't buy them. And a lot of people in their accounts, they either trade individual stocks themselves or they buy ETFs or index funds. And what they do to make money is they actually have, these stock brokerages actually have enormous amounts of cash balances. And the acquisitions that Charles Schwab, I think, is doing with TD Ameritrade. If they buy out TD Ameritrade, I think they're going to get a very, very low cost of capital. I saw an estimate for this. I think it's like a super low cost of capital. They're getting many, many billions of dollars more of capital in people's cash accounts, and it's called sweeping. And they do that to make loans and other investments in their. They take the cash from your account, normally overnight, sometimes longer. These stock brokerages also have like money market funds and other savings accounts and CDs that you can put in there, and sometimes they offer a higher interest rate. So the stock brokerage will offer you to put more cash into your account there, to move it from your regular bank account to their stock broker, to their one of their savings accounts or one of their higher yielding accounts. And these stock brokerages now have enormous amounts of cash and cheaper cost of capital than they did in the past. So they have large amounts of cash to invest. High yield index funds? That kind of sounds like a misnomer. What is it, a bond index fund? Oh, thank you for the super chat, Penguin. Oh, thank you for the super chat too, Max. I appreciate it. 1, 2, 3, 4. 4 super chats today. Cool. So I can't comment on the Secure Act yet. I haven't looked into it. I've actually been researching the deal that Kirkland Lake. I was looking at Triple Flag. I was looking at a couple different things in the last couple days besides doing more content. Triple Flag did not get their IPO money raised. There's a number of details. I'll talk about that. Maybe I'll do another podcast behind the Patreon account, the paywall. Either I'll do a podcast here about that. Triple Flag was trying to raise almost $300 million US to go buy more royalties and streams. They have 9 cash flow royalties and streams now, and another 5 or 6 or something like that coming online in the next 12 months. So they should have been able to get the capital raise, and there was a reason they didn't. There was arguments over valuation. I'll go into details on another show. And then also the Kirkland Lake Gold deal with Detour, it's a very interesting deal. There's a lot of complications to it, though. I'll talk about that. I have notes written for an audio podcast. I didn't feel that well yesterday, so I was planning on getting it done yesterday. I didn't feel that well. I wasn't able to get nearly as many things as I wanted to get done. Yeah, there's very low volatility for a lot of there's very low trading volume for a lot of these ETFs, and the underlying stocks in some of these ETFs don't have anywhere near the trading volume that the ETFs do. So the exit has not increased. There's all these Mike Green has talked about this on Dimitri Kofinas' podcast Hidden Forces, and also on Real Vision TV. He interviews people. So there's a lot of public commentators talking about this. Emma Molman has talked about this. So the ETFs are good for long exposure, but when you go to sell them, the exits are not as big. So even though the amount of assets under management for some of these ETFs is very large, there's not as much room to get out. So if a lot of people wanted to sell, there's not a lot of trading volume there to handle a lot of people selling at once in these ETFs. Okay, well, I think that's pretty much it. So in spite of all those things I have listed in the blue letters on the screen there, so U.S. budget deficits that are massive, the debt to GDP ratio high, Trump, it's looking like the federal government's projecting at least 1.2 trillion budget deficits going forward. The Fed doing a 180 on rate hikes and QT, then cutting rates and expanding the balance sheet. Hedge fund leverage, and all the volatility. The dollar has not gone down or even had a lot of volatility. It's been in fairly tight trading ranges on the regular dollar index and the broad trade-weighted dollar index in the last 12 months. So it'll be interesting. Then the other major question is the Fed capping yields, because that's where I think we're headed. I don't know the timing on this. At some point, the Fed just says the budget deficits are too large. and they're just going to start intervening. And if there's not demand for others to buy the bonds, the Fed's going to be monetizing basically everything to cap the yields. And this is what the Bank of Japan has been doing. Yep, IBJI says, is there really an ETF with a symbol JNK? Yep, junk bond yield. Yeah, and then the other one that's exploded in size is HYG. So the iShares, iBox, high yield corporate bond ETFs. So Harold, Yam, Greg. So those two junk bond ETFs now are absolutely massive. They're very big players now in the junk bond market. And a lot of these bonds trade by appointment only. So if a large stock brokerage firm wants to move some of their clients into some of these junk bond ETFs or get access to some individual junk bonds, they have to call up the custodians of the junk bond ETFs and they can negotiate side deals. Jim Bianco was explaining this in detail on the podcast over the weekend for Macro Voices. So Jim Bianco didn't go into any new details about the repo market on the interview over the weekend. I was hoping he would, but the interview Jim Bianco gave was still very interesting about the craziness going on in the bond market and junk bonds right now. So I'll actually put that Jim Bianco interview. That'll be 10 minutes or so, give or take, after the show's over. I'll put it at the end of this video. Give me some time to put the links there in the end. And thank you very much to everyone for listening. And now I can keep on focusing on quality content, information, research, analysis, and financial education. And maybe one of these days I'll find a new business partner or an investor to help me build my educational technology company.